Good morning and welcome to the News Hub. I'm Rolf Winkler. The monthly jobs report is coming in just now, and we will have full discussion of that with Sudeep Reddy from Washington. Sudeep, do we have the numbers on your end yet?
We certainly do. Non-farm payrolls rose by 175,000 during May, and the unemployment rate rose just a bit to 7.6%. Not much of a change. This is really very close to expectations. We were looking for something closer to 169 or 170,000. So this is very much in line with that. It really does keep us closer to that path that the Fed has been talking about for reining in its bond buying program later this year, perhaps as early as the fall. And so if we continue with payroll gains of this size, then we should be in pretty good shape. This isn't amazingly good news for the economy. It's still fairly moderate growth. It'll still take quite a bit of time to bring the unemployment rate back at this pace to where we want to be, but it's certainly moving in that right direction given all of the concerns about a summer swoon and all the other signs we've seen of a slowing economy.
Okay, Sudeep, talk a little bit about the path, the Fed's path that you referenced. What is the path that they have laid out to date?
Well, what they've been looking for is consistent, strong gains in payrolls. And what it seems to be, they're looking for something above 200,000 over time. If you look at the path over the last 6 months, we've been straddling that line when you pull the average numbers out. And that really means that perhaps the economy is finally taking off, finally gaining some of that momentum we've been looking for so many years. And it means we've come through the spring without a big breakdown. Perhaps we can get through the summer. The Fed is going to look through a lot of what we're going to see over the course of the summer, because we've already started seeing some ugly economic data on other fronts. Partly because of the sequester, the federal budget cuts, and partly because of tax increases from earlier in the year. And so it's more about the outlook, and right now it looks like the outlook might remain intact.
Okay, Sudeep, talk a little bit about some other economic indicators we've seen recently. In particular, manufacturing has been weak.
Manufacturing certainly was weak last month, and that was a big red flag for the recovery to see one indicator from the ISM dip below 50 for the first time, indicating contraction. We've also seen a lot of mixed signals on the employment front, and that's why you can't really take too much from a single report here, because we've seen signs of softening in employment in other ways, and that could signal that we're maybe on the leading edge of a slowdown in the labor market in other ways. But given all the fears of the sequester, we haven't fallen apart, which is a very good thing. Okay,
Sudeep, I want you to stay there. I'm going to bring in Phil Izzo, editor of the Real-Time Economics blog. He's in the newsroom. Phil, what's happening behind the headline numbers?
Hey, Ralph. I would second what Sudeep has said, where this number is on expectations, which is a good thing. It's not below. We're still growing at a steady, if unspectacular pace. And when you look into the numbers, it looks okay. We knew that manufacturing was a little bit weak this month. We got a nasty number on that earlier this week, and that was some pullback. We saw some job losses in the manufacturing sector, but overall there was gains. There was some pullback again in the government, which again we expect because of the sequester and other issues. But overall, there was a widespread job gains. There were not a lot of losses. There weren't substantial excellent job gains pretty much anywhere, but we did see gains.
What are the sectors that are offsetting weakness in manufacturing and government payrolls?
Well, I'll take a quick look, and the service sector is growing pretty substantially. That's where almost all of the payroll gains were. Construction added jobs, not a lot, but they did add jobs, so another signal that the housing recovery is continuing. And a lot of people are working in, there is concern though, because there's the sectors like retail, which are adding jobs, and there's a concern whether those are decent paying jobs.
Okay, Phil, keep digging through that report. I want to come back to you on labor force participation and revisions in a second. Before we do that, let's jump back to Sudeep. Sudeep, service sector. I mean, we're talking about restaurant jobs, et cetera, really, right?
Exactly. We're talking about the nature of the recovery we've had for the last 4 years or so. We've seen job gains early in the recovery in manufacturing. It gave us a lot of hope that we're going to come out of this with a more robust recovery. Seeing what we've seen in the service sector, which is of course the vast majority of our economy, we're seeing a lot of signs that the gains, the improvement in the labor market, that's going to go to people who are not necessarily going to get the best jobs that they're looking for. And so that's why you have to kind of look past some of these numbers, because it's still a very slow recovery. There's still a lot of softness under these numbers. And if we continue at this pace, we're looking at an unemployment rate that even if it comes down, it's going to come down slowly. 200,000 jobs a month, if we get to that point, is roughly 2 years of gains before we get down to 6.5%, which is, of course, the Fed's threshold for raising interest rates from that near zero level. And all we're talking about right now is slowing down its bond buying program, not even ending it. So there is still an incredibly long road ahead for normalization for the economy, for Fed policy, for everything that we've been hoping for. And it really shows that we probably have at least 2 or 3 more years of this recovery before we get some true confidence that we've come out of it and we've undone the damage of the financial crisis and the recession.
Okay, Sudeep Reddy, thanks for joining us.